Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm here for the first weekly economic review of the month of May 2021. And as usual, I'm joined by our chief economist, Clément Gignac. Good morning, Clément.
Good morning, Sebastian.
Hello. So it's a special day today. So I hear that it's your birthday.
Yeah, this time you have to trust the rumor. Indeed, yes. And guess what? I don't know if people follow sports, but I have the same number than the Twitter of Mario Lemieux, though 66. So it's a mixed feeling, I have to say, but I feel still very young. So back to you.
All right, so happy birthday on behalf of
Thank you.
everyone listening this. All right, so the week's markets at the close on a Thursday, so positive pretty much all around. Positive for bonds, interest rates were a bit lower, and this morning we had a so-so jobs report in the US, so that means more gains for bonds. Well, so far today, as we're recording, this market's just opened, so positive for bonds, positive for equities, the TSX leading the way, and you can see the Canadian dollar was up 1.14% on the week. So that means that the returns from foreign equities were lower than in local currency when you bring them back in Canadian dollars. So that means 1% for the TSX and negative pretty much everywhere except EFI, so Europe and Asia, being a slight positive. But we seem to be adding to these gains today so far. Year to date, the TSX is leading the pack in Canadian dollars, close to 12% returns. Oil was up, Canadian dollar, as I mentioned, was up, euro up, and the price of gold had a good week, 2.6%, and adding another percent so far this morning. So we'll see where we end the week, but a positive week all around for asset classes. So COVID, an update on the situation. On the left, you see that the number of new cases per million population is going either sideways or down. So the restrictions are working on this third wave, and the vaccination mostly is making itself felt. On the right, good news, Canada, we're up in now in the top four on this chart. 35.5% of the population has at least one dose. The US is 44.4. So we used to be more lagging the US than that, but the gap is closing. So that's a good thing. Our vaccination campaign in Canada is doing well. Of course, now Alberta is struggling with some issues on COVID, but we'll see if the vaccination campaign can make itself felt through the next few months, and we could have some good news later this summer and the fall with some reopening. In Europe, we're now officially in a double dip recession. Remember that an official recession is when you have two consecutive quarters of negative growth. So we had that in mid 2020. Q3 was very good. Q4 and Q1 2021 were negative, so that means that you have a double dip. So on the right, what you see is that in the US we are doing much better. Of course, all of the stimulus that was spent is helping, and also in the US it's easier for the government to navigate through these waters. In the eurozone, you have all of these countries, they need to agree with one another, so it's a bit harder. That's why it's leading, but still it's lagging. But that we still are very positive on European equities, because a lot of that is in the price and it's very cheap compared to elsewhere. And we will see the benefits of a reopening down the road in Europe. So we think it's a good place to be invested in 2021. In the US, the stimulus is driving personal income very strongly, and it is pushing consumer spending even more. So personal consumption on the left, we compare the 2020 recession with the 2008 recession. As you can see, the recession was much worse, much quicker in 2020. The 2008 one was a bit longer winded, but now the recovery is complete and we seem to be even overshooting already, which leads us to the chart on the right. This is from Oxford Economics, not from us, but the forecast that they have for 2021 would be the strongest year of growth of consumer spending since World War II. So very strong momentum there. So the consumer in the US is shouldering the recovery here with the help of the stimulus plans from the government. Inflation is surprising again. So on the left, you have the ISM services index. As you can see, we're close to 80 now, and 50 is the point where you have no growth. So above 50, you have growth, and the higher you are, the stronger the growth. And see, we are really going into the stratosphere here with the prices paid. And on the right, it's the inflation surprise index. So it's Citigroup, the American bank. What they do is that they look at the forecasts on Bloomberg and the forecast that they get, and they look at the real numbers that come out, and they just look at the surprises, are they positive or the negative, and the amplitude of these surprises. Well, now it seems that the surprises on inflation are as strong positive as they were at the peak of 2007, early 2008, just before the great financial crisis. So very high level here. But this morning, the star was the jobs report in the US and in Canada coming out. So in Canada, we lost 200,000 jobs, 2007,000 jobs. That's pretty much what was expected with the restrictions in Ontario, Quebec, and late in the month, Alberta too. So April was a month to forget. So we're now at 83% of the jobs that were lost through COVID that have been regained. In the US, we did create some jobs, so we're at 63% of lost jobs regained, but it was expected to be 1 million jobs added, and it was only 266,000. So we felt this morning Washington like pressing the panic button. We've heard some rumors that Mr. Biden wants to meet with his economic team today to assess the situation, see did they do enough, do they need to do more, what's really happening in the jobs market. So that plays also into the story of the Fed that yes, the recovery is there, but maybe it's not as strong as people expect. So we still need stimulus, we still need accommodative monetary policy, and inflation might not be as imminent as people expect. So it kind of plays into that story, but we'll learn more as we have more data points coming in for the next few weeks. So that's it for the economic part. So now for the financial markets, I hand it over to you, Mr. Schneck.
Thank you, Sebastian. Always interesting when you cover the economic part. Okay, financial market. Why not start with the postmortem of Q1 earnings? It was amazing. How good was excellent was in fact, the earnings. So, in fact, the first slide represents the earnings surprise. So 23%, it's almost a record when you see this kind. But what kept my attention, Sebastian, is to make a parallel with 2008, 2009, the great financial recession. So, in fact, we have a situation that at that time it was, in fact, negative earnings surprise. This time the recession was worse than 2008 or 10, but in fact, it's the opposite. Reason is simple. Federal Reserve as a backstop on corporate bonds. People have less concern about failure. Federal Reserve inject liquidity. Government send liquidity, bailout, wage subsidies, name it. So what a difference the policymaker has make this time and has done this time, and this is the most reason, and probably the fact that a lot of people working from home as well has boosted the profits and productivity. It's very interesting to illustrate on the right side. This is the net margin, in fact, that we have ex financial. So we can have, in fact, you can notice excluding financial, it's a record level. In term is very very interesting. Next slide. Next slide. In fact, it's about the value versus growth. You can notice on the bottom that it's related to the 10-year bond yield. So the 10-year bond yield is the right side. On left side, you have a value to growth ratio. You can notice a relationship between both. And the first slide is the same thing, 10-year treasuries, but it's cyclical compared to defensives. What is the bottom line? The bottom line is that we sticking, Sebastian and myself, with the view that the cyclicals, it's a favor compared to defensive and value compared to growth. Even this morning, the non-farm payroll is lower than expected and the 10-year treasuries has declined a little bit. We're sticking with our view, better to be in the financial and in fact, it's a rotation, vaccination campaign decline accelerate. So we really believe that we maintain that strategy. On the next slide. In fact, we have this warning from Federal Reserve. It's the financial report they have done, and they have done that on a regular basis. And they mentioned on Thursday that the rising asset prices are posing increasing threat to financial system. Fed Governor Brainerd said the situation bears watching and point out for importance of making sure that the system have safeguard. Okay, Security Exchange Commission regulation, capitalization, the bank, this kind of safeguard. And finally, notice asset prices may be vulnerable to significant, the word is important, significant decline, should risk appetite fail. So if, in fact, for whatever reason, we have a game changer and the investors' risk appetite fall, fasten your seatbelt. Maybe you will have more than just 5-7% correction. This is basically because valuation are quite expensive. Of course, interest rate is low, but make no mistake, you could have interest rate accelerate, long rates, I have to say, if inflation take Federal Reserve by surprise, for example. It's not immediate threat, Sebastien, as you know, it's more something, keep in mind, yellow flag, I would say, probably for 6 months from now, 1 year from now, but nonetheless, it's important to share with you. Finally, last topic, Canadian dollar. Whatever is our own model or Alpine macro model, even Canadian dollar has appreciated a lot recently. We continue to be bullish on Canadian dollar. Is far from overvalued. To the opposite, I would say still undervalued. Why? Because short rates Canada are than US. Copper price increase, commodity prices increase. So this is interesting. And finally, even if it's not in the model, public finance Canada is better shape than US. Even the job recovery, Sebastian has shown that it's better Canada than US. So we remain bullish Canadian dollar. This is not overnight optimism. We are optimistic that Canadian dollar, as you know, for the last 6 months, when it traded at 135, 236, we mentioned 130, 125. Now we mentioned 115. So, and we edge partly our funds that we manage, Sebastian and myself, we have the opportunity to hedge or not. So we continue to hedge aggressively our funds. This is what happened on my side. A lot of things to watch next week, Sebastian, I believe.
Sure, yes, always many things. Next week we'll have inflation figures in both Canada and the US. Remember what I've been mentioning for a few months, just the year-over-year effects on the level of prices will be pushing inflation up towards and beyond 3% starting next week. So we'll have the April figures. So both in Canada and the US, we should have that. Now the important thing will be to see how markets react to that, because the Fed and other central banks are very categorical, saying that they think it's going to be temporary and we should not worry about that. Let's see now how the markets think. So we'll see that in the US. We also have retail sales, so consumers doing well, so that should be good. Industrial production, same thing. We're reopening, so it should be good. And the housing in the US also doing very well. So expecting a good vintage of data points coming in next week. So that wraps it up for the week. It's for the week. ia.ca/economy is your go-to web page. You can always subscribe to the newsletter if it's not done already. If you want to copy a PDF copy of this presentation, just write at economics@ia.ca and we'll send it to you. So thank you everyone out there for following us on a weekly basis. Thank you, Mr. Gignac.
Thank you and have a nice weekend.
Thank you, you too, and we'll be back next week with another edition of the Weekly Economic Review.